A global pandemic shuts down the economy. A trade war tears apart the supply chains that have defined global commerce for decades. A massive conflict suddenly disrupts the flow of the world's most essential energy commodity. By all normal laws of economic gravity, these events should have triggered a devastating financial collapse. Instead, within just a few months of each disaster, the stock market completely shrugged them off, rebounding rapidly and smashing right through to new all-time highs. We haven't always seen this kind of invincibility. Following the crash of 1929, the stock market stayed tethered to a mediocre economy, essentially flatlining for 24 painful years. We saw the exact same pattern of long-term stagnation in the 1970s, and again between 1998 and 2011. Today's stock market has completely decoupled from the actual health of the underlying economy. The relentless buy-the-dip reflex we've seen over the last 15 years is a historical anomaly. Decades ago, Warren Buffett established a simple mathematical boundary for investors. He stated that you would have to be wildly optimistic to expect corporate profits to hold anywhere significantly above 6% of the total U.S. gross domestic product for any sustained period of time. This line graph maps out corporate profits against the sheer size of the U.S. economy. You can clearly see Buffett's theoretical 6% ceiling. But look at what happens over the last 15 years. The line completely shatters that ceiling, doubling Buffett's limit to sit comfortably at a staggering 12%. Now, if we add a second line to track the personal income of the average American worker over that exact same 15-year stretch, it barely moves. Corporate wealth has grown at an incredible pace, while average worker salaries have remained completely stagnant. A core law of economic physics has been actively suspended. The stock market is operating inside a highly pressurized bubble, entirely detached from the financial reality of the middle class. In a healthy market, extreme corporate profits are supposed to be self-correcting. If a single company starts making massive margins, new competitors naturally rush in to steal their customers by offering lower prices, which forces those profit margins back down to earth. There's also a built-in negative feedback loop. When corporate profits swallow up a massive chunk of the GDP, workers inevitably end up with smaller paychecks. Since those workers are the actual consumers buying these goods and services, their shrinking budgets eventually destroy the demand that generated those outsized profits in the first place. Neither of these natural checks and balances are functioning right now. The market isn't correcting itself, which means a powerful outside force has to be actively holding financial gravity at bay. That force is the U.S. Federal Reserve. Throughout the 2000s and 2010s, core inflation in the United States stayed quietly below 3%. That uniquely low inflation environment gave the central bank the perfect cover to aggressively intervene whenever the market stumbled. Every time a crisis hit the real economy, the Fed unleashed the exact same playbook. They aggressively slashed interest rates to zero and pumped massive waves of cash straight into the financial system to stabilize the panic. If we map out exactly how this money travels through the plumbing of the economy, the design flaw becomes obvious. The liquidity flows straight from the Fed into the banking sector, where large corporations scoop it up as cheap debt. A massive reservoir of this cash pools directly into corporate profit margins, while only a microscopic trickle ever reaches the wages of the average worker. The U.S. Treasury Secretary has even referred to the Fed as an engine of inequality. By subsidizing corporate borrowing costs while the middle class stagnates, the central bank accidentally engineered a permanent cushion for the top end of the market. The massive market returns of the last decade aren't a reflection of a booming, healthy economy. The stock market has simply been surviving on an artificial life support system operated entirely by the central bank. But the macroeconomic environment has suddenly flipped. Core inflation has surged and is now hovering stubbornly at its highest levels since the 1980s. This highly sticky inflation completely paralyzes the Federal Reserve. If the market crashes tomorrow, they cannot simply slash interest rates to zero or print another $1 trillion without sending consumer prices into a hyperinflationary death spiral. The ultimate safety net has been removed. After 15 years of artificial support, the financial gravity we've been dodging is about to forcefully rip those record corporate profits back down to reality. When the central bank loses its ability to subsidize the market, broad index funds become vulnerable. Without the guarantee of a Fed bailout, the index stops being a safe haven and begins to reflect the full, unshielded volatility of the real economy. Protecting capital in this environment requires a shift toward sectors with intrinsic value. companies whose growth is driven by physical necessity or scientific advancement, rather than access to cheap credit. We have to look for businesses that produce tangible value that a high inflation environment cannot erode. This is why the biotech sector is currently outperforming the broader market by 80%. Because these metals are the non-negotiable physical inputs for the next decade of technology, the mining sector has a floor of demand that isn't dependent on market sentiment. The mechanism that sustained the market for 15 years has reached a structural limit. Success now depends on moving capital away from liquidity-driven assets and toward the physical and scientific foundations of the economy.